Since reaching a high of $3.16 in October 2020, Keppel DC REIT share price has fallen by more than 48% to $1.62 as of 5th February 2024. However, despite the drastic drop in share price, I still remain invested in Keppel DC REIT for now, and here are my reasons why. If you look at Keppel DC REIT's share price decline over the past 3 years, the share price decline in 2021 was mostly a result of market correction from the highs experienced during the COVID pandemic, and possibly also due to the change in Keppel DC REIT's investment mandate from being a pure-play data center REIT to one that invests in assets necessary to support the digital economy. The decline for 2022 onwards till date was a combination of two factors: a high interest rate environment and related tenant uncertainties. Of the 3 non-tenant uncertainties, 2 are close to or have already been resolved favorably: the sale of Sextera to Brookfield in November 2023, and the uncertainty of gross rental income for Keppel DC REIT's GV7 data center, which was previously wholly occupied by Sextera. The recent court decision in favor of Keppel DC REIT in its litigation lawsuit against DXC Technology should also see Keppel DC REIT getting some form of monetary payment. However, while the full amount that Keppel DC REIT is claiming is $14.8 million, the actual amount to be paid will only be known after the trial in February 2024. Nevertheless, it should provide some upside to DPU for 2024. The only tenancy cloud left hanging over Keppel DC REIT is the ongoing rental payment arrears from its tenant occupying the 3 Guangdong data centers. While Keppel DC REIT management remains in active discussion with the tenant on recovery roadmap, I think it's prudent to completely remove any rental contribution from the Guangdong data centers for any future DPU projections. With that in mind, I would assume a full year FY 2024 DPU of 8 cents. With the current market price being $1.62, this translates to a dividend yield of around 4.94%. With this yield, I think the market has more or less already priced in much of the negatives surrounding Keppel DC REIT. While Keppel DC REIT DPU performance was poor for 2023, its financial health has been rather resilient in this high interest rate environment. Keppel DC REIT's aggregate leverage percentage came in at 37.4% at the end of 2023, as compared to 36.4% at the end of 2022. This leaves a debt headroom of around $169 million before Keppel DC REIT hits its internal cap of 40%. The average cost of debt in 2023 was 3.3% as compared to 2.2% the previous year. With this increase in debt costs, coupled with the rental arrears mentioned earlier, Keppel DC REIT's interest coverage ratio for 2023 fell to 4.7 times, as compared to 7.6 times the previous year. For these metrics meant that Keppel DC REIT was slightly worse off in terms of financial health as compared to 2022. A roughly 100 basis point increase in underlying debt matrix isn't that bad if you consider the interest rate environment that we are in. Furthermore, if you exclude the rental arrears from the Guangdong data centers, Keppel DC REIT's DPU for 2023 would have been at 10.032 cents, which was a 1.8% decrease from 2022. With rate cuts likely to happen in 2024, there could be small incremental improvements to Keppel DC REIT's debt matrix. However, I do not expect a huge improvement as Keppel DC REIT will be refinancing around 4% of total debt in 2024 at likely higher rates than before. Still, I would say that the worst is most likely over in terms of interest rate if everything remains status quo. Apart from its rather healthy financial position, Keppel DC REIT has also experienced positive growth over the past few years. Revenue, net property income, and distributable income increased at a 5-year compounded annual growth rate of 12.5%, 11.6%, and 14.9% respectively. In terms of DPU and NAV, both increased at a 5-year compounded annual growth rate of 6.4% and 5.9% respectively. This positive growth trend underpins the central role that data centers have in this current digital age. I think most of us are aware that we are currently at an AI growth stage, where demand for high-performance cloud computing remains high. Based on a Bloomberg report, the generative AI market is expected to grow to a $1.3 trillion market by 2032. On top of just the generative AI market, data center demand will continue to be supported by networking infrastructure needs for things such as cloud gaming, music and video streaming, and also for the IoT industry. This perhaps explains why the data center market is expected to grow at a compounded annual growth rate of 9.6% till 2030. Besides the continued demand for data centers, there's also limited amount of supply coming into the market. In the Singapore market, which accounts for 51.5% of Keppel DC REIT's total gross revenue, new data center supply remains low due to the stringent criteria after the lifting of a temporary data center moratorium. In 2023, only 80 megawatts of data center capacity was awarded to 4 operators. This adds on to the already existing 970 megawatt capacity, excluding any planned or under construction capacity. The limited supply of data centers is also not exclusive to just Singapore. In Ireland, we contributed 11.9% of Keppel DC REIT's total gross revenue. There's a moratorium currently in place for new data centers till 2028. Thus, with this limited supply of new data centers, coupled with relatively high demand, I expect more growth opportunities for Keppel DC REIT in the coming years. While the market growth prospects remains bright for Keppel DC REIT, there's a valid concern regarding the attractiveness of Keppel DC REIT's data centers. If you look at the occupancy rate of Keppel DC REIT's co-location data centers, 3 out of the 5 co-location data centers in Singapore are on a downward trend in terms of occupancy rate. The current occupancy rate of these 3 data centers are also above the Singapore market vacancy rate of 2%. While there is no definite answer for the lower than market occupancy rate for the Singapore co-location data centers, I would speculate that much of it is due to rental pricing. As mentioned earlier, the data center market in Singapore remains tight due to limited supply and high demand. This equates to higher rental rates for existing or new data center spaces. A CBRE report in 2023 highlighted that Singapore has one of the highest rental rates in the data center market as compared to other major Asian cities such as Hong Kong and Tokyo. Given that tenants for co-location data centers are often enterprises instead of hyperscalers, these high rental rates could price them out from renting with Keppel DC REIT, especially when there are cheaper alternatives in Malaysia or Indonesia. Furthermore, given that most co-location leases pass through a bulk of the associated utility costs to the client, higher water and electricity costs in Singapore thus translate to higher operating costs for clients. With Singapore's electricity tariffs and water prices set to increase in 2024, we could see smaller enterprises choosing not to renew their leases to Keppel DC REIT and instead opting for cheaper alternatives in neighbouring countries. This could potentially cause some issue for Keppel DC REIT, as 27.5% of rental income is up for renewal in 2024. Of course, all this remains purely speculation and worst case scenario pointers to note if you are investing in Keppel DC REIT. If you were to consider Keppel DC REIT's track record when it comes to lease renewals, the REIT has been able to achieve positive rental reversions over the past few years. So perhaps there's not much to worry about. However, one thing that current or potential investors want to look out for is Keppel DC REIT's future acquisitions. The latest acquisitions of the quantum data centers have cast serious doubts on the decision-making of Keppel DC REIT's management team. For instance, why would REIT management team be comfortable deriving around 7.8% of gross rental income from a client which is not in the best financial shape? This is especially damning when the client's parent company is publicly listed and its financials are readily available. Were there promises or guarantees made regarding the acquisitions, or was it a gamble by the management team on the recovery of China's economy post-COVID lockdown? Because of the reasons, I think many investors will be looking at how Keppel DC REIT's management team account for themselves in the next AGM. Nevertheless, for the acquisition of the quantum data centers were not great, we should not overlook the general success that Keppel DC REIT had with previous acquisitions made over the past few years. We can see that both DPU and NAV have increased in tandem along with the acquisitions made over the past 8 years. So I guess the management team does deserve some slack, but maybe not too much. In terms of the pipeline of acquisitions, there is more than $2 billion worth of data centers from Keppel DC REIT sponsor and also other Keppel-related private data center funds. In other words, there is no shortage of growth opportunities, but it's all down to growing sustainably and positively. With all that said, Is Keppel DC REIT an attractive investment right now? If you were to look at historical data, Keppel DC REIT is currently trading below its 5-year price-to-book ratio. This is even factoring in a 50 basis point reduction due to the high interest rate environment that we are in. From a dividend yield perspective, presuming a full year FY 2024 DPU of 8 cents, the current dividend yield of 4.94% is slightly above its 5-year trailing dividend yield after factoring in a 100 basis point increase due to the interest rate environment. Personally, I will still wait for the price to drop a little more before purchasing more units, and this is due to 3 main reasons. Firstly, I prefer buying into REITs with a dividend yield of at least 5%. This was up to a unit price of $1.60 or lower. Also, while Keppel DC REIT is trading at previous support levels now, its price could drop further given that the previous support level was reached in the assumption that the Guangdong DC tenant was still paying the rental payments as per normal. However, now that we've gotten more news of the trouble that the Guangdong DC tenant is facing, the markets might discount Keppel DC REIT even further than the previous support level. Lastly, there is still a prospect of equity fundraising happening to fund Keppel DC REIT's next acquisition. Management has previously mentioned on multiple occasions that equity fundraising will be the likely option to fund the last payment for Guangdong Data Center 3, coupled with another acquisition. With that payment not pretty much in limbo and a new CEO in place, it remains to be seen how Keppel DC REIT will finance its next acquisition. All in all, whether the current market price is attractive right now or not is highly dependent on what your DPU projection for the REIT is and your own acceptable dividend yield. As a whole, while the Guangdong Data Center's tenant saga is unforgivable for Keppel DC REIT, it is still strongly poised to benefit from growth in various industries not limited to AI, cloud computing, and networking. Thus, I am still cautiously optimistic about the REIT's prospects for the next few years and continue to remain invested in it, barring any major negative developments. Nevertheless, I will still keenly watch and scrutinize its next acquisition. If I'm thinking whether to sell or buy Keppel DC REIT, I would say look beyond the negative news and properly consider the REIT's fundamentals. Thereafter, decide if the REIT is worth a place in your portfolio for the mid to long term. With that, I will see you all in the next video. Goodbye.